The 75% wage subsidy bill for employers was officially passed in the House of Commons on Saturday, April 11th, 2020, and later that same day received royal assent. This program is referred to as the CEWS, the Canada Emergency Wage Subsidy, and I'm just going to call it the CEWS. Much of the information has not changed since my first video on the CEWS, which was published on April 5th. So I'm going to highlight the main changes. Now, remember, with the CEWS, you have to apply for it, and it provides a 75% wage subsidy up to $847 per week per employee to eligible employers. The CEWS subsidy would be available for up to 12 weeks, and it's backdated up to March 15th. I'm just putting the finishing touches on the calculator for business owners who want to know how much the CEWS would be worth on an individual employee basis. I should have that ready later this week, maybe by the weekend. The major changes now that the CEWS is official is the eligibility criteria with respect to the revenue drop a business must have suffered, and a new refund of 100% of the employer-paid contributions into EI, CPP, or QPP, and the QPIP, the Quebec Parental Insurance Plan, if applicable, by employers for each full week that you can claim CEWS for a worker that you have put on paid leave. So to make that clear, one of the additions of this program is that you can now get a 75% wage subsidy to pay employees and have them stay home, and this extra incentive will cover these payroll contributions you as an employer would have to make. Now, as we know, you need to have a revenue drop to qualify. That's not new, but there's been a modification in how much that drop needs to be. And now you also have two reference period options to choose from in how you calculate this drop. But don't worry, I'm going to explain it to you. So the periods you need to measure the revenue drops against are known as the reference periods. There are 3 individual months of revenue from this year, March, April, and May, that will be compared to these reference periods. So for March of this year, you need to show a 15% drop in revenue against the reference period. But for each of April and May of this year, you will need to have a 30% drop in revenue against their reference periods. And originally, it was also 30% for March, but it's been dropped to 15%. And that's because many businesses didn't really start to see a decline in revenue until partway through March. And so the federal government has made this change to the CEWS program. You can also now choose one of 2 reference period options. You can choose to compare revenues against the same month from a year ago for all 3 individual months. So March versus March, April versus April, and May versus May. Again, 2020 versus 2019 in each of those cases. Or you can choose to compare each month this year to the average monthly revenue of January and February of this year. So for clarity, what this means is that you could compare March 2020 versus the average revenue for the months of January and February also of this year, 2020. But that same method would have to be used for each subsequent period during this program. So when it comes to April 2020, you would also compare this to the average revenue of January and February of this year, and so on. So whatever method you choose to begin with, you have to continue using that method if you want to see if you continue to qualify for future periods. Now, another change is that if you qualify for one period, then you automatically qualify for the next period. So that's great. In other words, if you meet the criteria for the March test, you automatically qualify for periods 1 and 2. You would then have to requalify for period 3 if you wanted to get all 3 months of the subsidy. If you didn't qualify for period 1, but you do qualify for period 2, then you automatically qualify for period 2 and 3 as well. And if you didn't meet the revenue drop requirement for March or April, periods 1 or 2, but you do in May, you'll just qualify for period 3, as there is currently only 3 periods in the program in total for now. Finally, you can choose which accounting method you want to use for measuring this revenue drop. You can either use what's called the cash method, And this is where you report income when it hits your bank account, or the accrual method, which is basically you would report income when you've earned it, whether or not you've actually been paid. Whichever method you choose, you have to stick with that method for each reference period comparison. Okay, so for each period that you qualify for, and remember there are 3 periods, the claiming periods are as follows. If you qualify for the first period, the claiming of that subsidy applies retroactively to remuneration paid between March 15th and April 11th. Period 2, the claiming period would be April 12th to May 9th, and period 3 would be May 10th to June 6th. Okay, so that's a lot to go over. If you have any questions, leave them down below. I'll do my best to answer them either in a follow-up video or directly to your comments. Also, if you want to subscribe to my feed on whatever platform you are watching this on, you'll get notified of updates, like when I publish that calculator for the CEWS that I'm building right now. The CERB, Canada Emergency Response Benefit, Canada Child Benefit, and GST Special Payment Calculator that I had put out for individuals was quite popular. It was used over 140,000 times. And so now I'm going to get to work on this CEWS calculator. In the meantime, I hope you are staying vigilant. I hope you're staying safe, and I will see you in the next video.